Well, the Middle East is boiling, and that is why developing economies like Ghana are talking about building reserves and buffers. In an uncertain situation like this, how do you even build reserves? In Ghana's situation, unlike maybe Nigeria, where although crude prices are up, and we are talking about it in Ghana, Nigeria is going to cash in because prices have now skyrocketed. I don't want to use that word anyway, but it's now around $78 per barrel if you're talking about the Brent side of the trade. And in terms of Ghana's situation, we possibly are not building the reserves we want currently on the wheels of crude prices rising, but on a different commodity, and that is gold. And what is our target? Our target is to build gross international reserve of 15 months by the end of 2028. This is a very, if you look at the hurdle to cross in terms of how much we need to actually get this 15 months of imports cover, we're talking about more than $9 billion US. That's how much we need so far. But there's a lot of confidence coming from the boom in the gold space, where prices are still very elevated, remaining about $5,000. And if you speak to those who are very conversant with this commodity, they'll tell you that within the medium to long term, some even say long term, some say within the short term to a medium term, they expect gold prices to remain very elevated, about $5,000 US per ounce. And that is where Ghana is hoping to cash in. And unfortunately, when global shocks come as a result of commodity crisis, usually when it comes from cocoa, we feel the pinch, and it's usually a bad one for us. But when it comes as a result of gold prices going up, we always have to sing the Hallelujah chorus. And that is the song we are hoping to sing by the end of 2028. Because the president himself spoke about it during the State of the Nation address. And we know that the current economic stability we are getting significantly, part of it is coming from gold. And the president says that, well, if you look at what is going on in the gold space, they believe that within the next 3 years, gold prices are projected to remain very, very stable. And he says that, well, we are beginning to take advantage of that. We've cashed in already from the setting up of Gold Board, which everybody knows that because of that, we were able to get in excess of $10 billion US from the small scale gold aspect, which hitherto would have gone to a significant part, would have gone to smugglers. The president says he believes, or per what they are learning, gold prices will remain elevated in the next 3 years. And that is why the finance minister was in parliament to actually present this and said that if you look at Ghana's, reserve, the accelerated reserve policy, this is where we want to be, 15 months of import cover. Because by the end of this year, the finance minister who actually presented it says that, well, we are currently around 5.7 months of import cover, but by the end of this year, we are hoping to be around 8.6 months of import cover. We need a lot of dollars and gold to actually get to this point. And by the end of 2027, before the 2028 election, government wants to be around 11.8 months. And if we're able to do this, this will be the first time we are getting to that point. The average, the standard point has always been around 3 months of import cover. And when we fall below that, that is when we always go to the IMF for that bailout. But in terms of our reserve, and just like I painted, this has been the trajectory in the last decade, where from 2016 to 2025, you can see how we have actually hovered within the average of, 2 to 4 amount of import cover. This definitely, as you see it this year, is an outlier. 5.7 months of import cover within the span of 10 years, complete outlier. And where is that coming from? Coming from the strong wheels of gold. And that's why government is hoping to cash in on this, build buffers and hedges before maybe price begin to even fall. So within the next 3 years, we've presented an accelerated program to actually get a lot from the gold boom that we are seeing globally. Because if you look at our situation, these 4 commodities have always been where we get our reserves from, and in terms of foreign exchange, these are the top earners. Gold, always number 1, cocoa always follows suit, and in terms of crude oil, and maybe we talk about other non-traditional export. But in years, you can all attest to the fact that in the past 8 years, monies or inflows from Eurobonds were the go-to source, on average about $3 billion every year to show up our budget and also to stabilize the city. With that coupled with cocoa. But cocoa has fallen, and we checked for you in the afternoon where we saw that within just 1 week, cocoa prices have fallen below $3,000, fallen by some 12% in just 1 week. And if you go on the gold space, the story is different. Prices continue to rise. Crude oil, very, very fluctuating. And I don't know if it will be that, ideal to be planning around crude oil. Unfortunately, in developing economies like Nigeria will still have to plan around crude because that's their main top, export earner. But we have an opportunity to choose between the top three, which is either gold, cocoa, or crude oil. But at the moment, we all know where the direction is inflows from gold that we want to build the reserve from. And what is the aim? The aim is that weekly, government is hoping to purchase some 3.02 tons of gold every week. And a significant component of that is going to come from the small-scale gold aspect. And the large scale will also take, part of that. Just like I said, 80% of what we are hoping to purchase every week will come from small-scale gold, and about 18%, close to about 20% is going to come from the large-scale aspect. And I'm interested in this because if you are looking at how we are going to fund this, and when my guest joins me, this part for me is very, very important. How we are going to buy the gold and how much we are going to sell it, because we know there are costs attached to it. And if we don't take care, we possibly will be repeating what happened in previous years where we had to run programs like gold purchase and all of that. Because in the large scale, government is hoping to buy the gold at a discounted price. But if you look at it on the small scale side, you begin to see a different story where Gold Board in this picture is going to buy gold on the spot market. And why? Because Gold Board is trying to do away with smuggling, to discourage smuggling, and so you need to sell a spot market. But at what cost? We will find answers to those questions, and we'll make sure that we get answers so that this do not become another burden on the country, because we've already seen what happened in 2025 from the Bank of Ghana's gold purchase program. And we're asking even where the funding is going to come from, because we know the finance minister said that, well, they are going to provide budgetary allocation to Gold Board to be buying this. We saw that there was a promise to provide Gold Board over $400 million as a seed fund for the Gold Board operation. That did not come in early, and the Bank of Ghana had to step in. Losses were made, and at the moment, we still do not know on whose books those losses will sit. But beyond gold, the government is also hoping to actually add these as buffers from inflows from cocoa, from remittances, which we know currently is above about $6 billion annually, and developing new oil fields, which we've spoken about and said that the president says that, well, if you're an investor, start coming in because we want to drill, baby, drill, as Donald Trump will say. And also boost non-traditional export. The finance minister has been very, very heavy on, oil palm. That is going to be some of the additions to heavily relying on gold to build this 15 months of import cover reserve that we strongly want to be at by the end of 2028. You can see the trajectory in terms of remittances, and you can see huge sums coming in there. 2012 alone, 7.7 billion. The average has been in the last 3 years has been around 6 billion. This should tell you that in terms of the other sources that we are hoping to use to cushion the inflows from gold, remittance is one space that we can actually rely on if we do our things right in terms of tracking and tracing. Very, very important. And in terms of gold reserve, remember there was a point where we spoke about how the reserve dropped. The Bank of Ghana has already explained that at a point they had to sell a portion of that to be able to take advantage of what was prevailing in the market. And that's why you're seeing the drop. But currently it's around 18.6. And the government is hoping to make sure that they actually increase this in the coming years with this new policy. But this is actually our position at the moment in terms of building reserves from gold. Our gold reserve globally, Ghana is 70th, and on the African continent, we are 7th. But I keep asking the question, for a country that was able to export over $20 billion in terms of gold in 2025, why should we be 7th in terms of when we're talking about accumulating reserve from gold. After this short break, my guests will join me and we'll find answers. We'll try and see the technicalities involved, try and ask the most important question that you always want to ask in terms of the cost involved and how this is going to benefit the country in terms of building reserve, especially in a current time where the Middle East tension is actually testing the pulse of reserve that are being built by developing economies. Stay with us after this short break. My guests will join me. Well, thank you very much for staying with us here on PM Express. And PM Express, as we always know, is brought to you by Syntex Tank. It is strong, it is tough. Pepsodent Cavity Fighter Toothpaste, Stanbic CIB Impact Series. Now, Ghana, let's talk water tanks. Do you know the secret to real water storage? It's simple. If your tank doesn't have the tortoise on it, and it's not the correct tank. It is strong and durable and built to handle our Ghanaian weather, rain or shine. Syntex Tank, a strong, a tough. Pepsodent Cavity Fighter, and as you always know, every time we eat, food and sugars are trapped between our teeth, leading to tooth decay and gum disease. And in some cases, for our breath, brushing your teeth every morning and at night with Pepsodent Cavity Fighter, this prevents cavities and keeps your teeth strong and mouth very healthy. And Stanbic CIB, some see challenges, but I tell you, Stanbic will always see opportunities. Where are there spot risk? They will always spot or unlock value. As Stanbic Corporate and Investment Banking, they stand with partner businesses and driving Ghana and Africa's growth from energy to mining infrastructure to trade. They finance ideas, enterprises, and empower economies. Call 03028-15789 to speak to any of their CIB team or visit stanbicbank.com.ga to get started. Stanbic Corporate and Investment Banking, driving growth, creating sustainable impacts. And I must say that we've actually assembled the best guests, actually, the right brains for this conversation. And joining us from the US via Zoom is Professor Williams Kwesi Price, an associate professor of finance at Andrews University in the US. Dr. Theo Echampon is a technical advisor of to the finance minister and also an economist. I'm glad to have him in studio. We always speak to him via Zoom, but tonight he has joined us in studio. And from the corridors of Parliament, we have Chenebo Akodia Fokuo. He is Deputy Ranking Member of Economy and Development Committee and also MP for Manso Kwanta. He will join us also via Zoom. But gentlemen, I want to welcome you to PM Express. Although I want to start from Dr. Theo Echampon in studio. I was having a conversation with him before the show even started about how is it like to move from the policy space to now advising the finance minister. What you do at the finance ministry now, is it more of policy? How different it is? What has your experience even been like, when you join advising the finance minister? How is it?
No, thank you. It's been a very good experience, I must say. Working on a lot of deep policy issues, bringing some of the technical, now's background to the issues, whether it's issues to do with, reserves, which we'll be discussing in a moment, or issues to do with setting up of a fiscal council to help us, deal with some of the perennial debt oversight and the recklessness in spending that we have seen, since time in the past, whether it's working on energy broadly or extractives, oil and gas, mining. Yeah, you really have a very good team of people that you're working with the civil servants, the staff at the ministry, with the directors, and then, of course, with my minister as well, who's really open to fresh new ideas, innovative thinking, and trying to steer the course of the economy towards the right direction. Really, the idea being that, yes, we have some modicum of stability, but stability in and of itself has to be a means to an end. The end really being that the economy has got to grow more, it's got to create jobs, and then we need to have productivity as well associated with that. And that's really what occupies a lot of my time.
Top mind in the policies, but I'm wondering how the call came in. How was it like when the minister called you? Was it a text? Was it a call? Was it via email? How was it like?
It was just a call to come and serve. So
I see.
It's national service. So.
Great. This national service has actually got you talking about an important document. I mean, which the finance minister actually presented to Parliament and before us for analysis. The accelerated reserve, policy, the gun wrap. I really want to understand. There are a lot of technicalities involved here. How did you come up with a document? What is actually contained in this new accelerated, reserve building? I see government wants to get about 15 months of import cover, and that will mean that on average you need about 3 billion every year, right?
No, about 9 billion.
9 billion every year. That's huge. How are we going to get that?
Yes, okay. So it comes from two things. One, the price of gold itself, and then two, the volume, right, of gold. So if you actually look at the document very carefully, we present various scenarios in the document which shows you where the gold is going to come from, two sources, from largely the small-scale mining sector, where you're looking at getting around 127 tons of gold annually. Last year, we did 103, 105 tons, thereabout. So you almost have to scale it up by another 30% for this year. And then for the large-scale mining sector, you're looking at getting close to around 2.6 or so tons, to add up to what you need to meet up, on an annual basis. Then you also have the pricing side of the equation. Of course, gold has been at historical all-time highs. And if you look at all the different forecasts that have been produced by some of the major investment banks, some of the major multilateral banks, and even internally within the ministry itself, everything indicates that you're likely to still have this tail, wind that you can actually leverage on for the next 2 to 3 years. So the idea really is that, okay, what do you do to actually take advantage of the potential high prices that we have seen in relative historical terms to build a buffer, or as we put it, to build a war chest. Now you're building the war chest, the reserves is not a means or an end in and of itself. It's a means to an end. The end really being that you're able to support your currency, support your economy, and ultimately, translate that into jobs. Because if you look at the data, and then we've been doing some sort of work around this, so you can actually take the gold data, take our gross international reserves, take inflation, take exchange rate, and then do some sort of correlation and even causality, analysis. And just to be maybe a little technical here, but I'll try to explain. The relationship between gold and our gross international reserves, the correlation there is actually positive. The coefficient is about 0.64, and this is highly statistically significant. Yeah. What that really means, in very simple terms, for the purposes of our listeners, is that when gold prices go up and the volume also goes
1 unit,
up,
right?
Sorry.
When gold price go up by, say, 1 unit, you expect your reserve to go up by some 0.6.
By around 6 something, or 0.6 in that range. But the important thing is not even the size, it's the direction. It's a positive sign, right?
It's more than 0.5, right?
And 0.64. And then when you look at your reserves to inflation, you do the similar analysis, actually that is negative, right? That's about 0.76. So what that, again, is telling you really is that when you move from your reserves, higher reserves, as a result of the higher gold, the volumes that you're getting, and then the higher price, you're actually able to get the revenues that you need, and you can use that to support your exchange rate and thereby lower, inflation. And this is really, really important, because unless you've done a bit of the detailed technical analysis, you begin to see why, you have this window of opportunity, 2 to 3 years, to really build and prop up the reserves. Again, you can go back, look at the Asian economies. In the aftermath of the 98, 99 Asian financial crisis, many of these economies, from Thailand to Vietnam to Laos, all of them realized that you need to build, buffers. And you look at the evidence base, most are doing on average about 10 months, sometimes 8 months of import cover. The IMF and other organizations will tell you, yeah, you need maybe about 3 months of import cover. However, given the structural vulnerabilities that the Ghanaian and many other such economies face as a result of commodity price exposure, as a result of the fact that you are not transforming right enough, you actually need to build a far bigger buffer than the traditional 3 months that one needs to do. So that's really sort of call it the thought process that is driving this policy initiative to try and build enough reserves, but importantly to use that reserve to support your exchange rate and ultimately help you to sort of sustain or even lower the inflation levels.
I'm interested in the other variables you spoke about. You spoke more, you listed more than 2 variables, right?
Okay.
That was inflation.
Yep.
Then gold reserve, right?
Yep. And then the exchange rate.
The exchange rate. Well, I want to know the coefficient for the exchange rate. Very important.
So international reserve to exchange rate is minus 0.10.
0.10.
So, yep. And then you can look at gold itself directly to the exchange rate. So the channel will still be through the reserves. That is 0.55, but it's a positive plus 0.55.
So in terms of the negative impacts, where the inverse relationships, where
you're right,
I see inflation being the highest.
Yes.
Right. So how is this policy going to address that? Looking at a coefficient of 0.76, almost 0.8, that's very high.
Yeah, no. Because again, if you look at our historical inflation data, you've got a lot of imported inflation. People that are bringing in goods to come and sell. And anytime the exchange rate is all over the place, we feel it directly. That's the first point, right? So if you have enough reserves in there, and you actually, in times of crisis like this, are able to use it for 2 things, you can use that to smoothen your currency, right? So what the central bank now does these days under the managed float system, where they're able to offload, dollars on a weekly basis through the auctions to the banks, that allows you to do that and keep the exchange rate stable. That's the most important thing. So if you're an importer going to bring goods and all of that, when you've got that relative stability, you can actually price relatively well, and that benefit would be passed on, hopefully, to consumers. That's the first thing.
Okay.
Then you can talk about call it on the export side, of things, and the big reforms that also need to be done, So think about it this way. In the medium term, in the next 2 years, you have this potential windfall. In the next 3 to 5 years, you need to do a lot more work to try and grow the economy. So you showed a chart that has things to do with growing non-traditional exports. Things that have to do with getting, oil palm, The 500,000.
The minister is very passionate about.
Absolutely, because that also creates jobs. You talk about reducing the reliance on crude oil imports for our power generation needs. So if you have a lot more domestic gas resources, you're actually able to save significantly on your energy bill, and that is passed on to consumers. There's also the whole talk about even growing more of what you eat, domestically here within the Ghanaian economy. But those things are not going to materialize overnight. It's things that you have to do sustained over a period of time. So think of it as a 2-pronged strategy. The first thing being gold prices are high. You have a 2 to 3 year window. What do you do? And then secondly, what do you do in a more medium to long term as you're building up the reserves and sustaining your currency to translate that into structural transformation?
That's an interesting stochastic process there. So when I come back, I want us to look at how we are going to fare when we move from between states. How is it going to be for us in terms of the buffers and reserve that we want to build? But I want to go to the US now and speak to Professor Williams Prepra. And Prof, 15 months of import cover, and if you check the document, heavily reliant on gold. A big gamble?
Good evening to you. Dr. Teo, good evening. So my initial assertion is that, I support the policy, but it's too ambitious. The 15 months is too ambitious. We all know there is an opportunity cost for taking this decision. the direct cost that probably may come with this is where are we going to get the funds from to be able to buy the gold? That kind of money, that amount of money could have been used in meeting some developmental needs now. But what we are doing as a country is to probably defer growth, let me put it in that way, defer some bit of growth and safeguard our future. We may have to really find a balance. In both developed countries and developing countries, most of them, as Theo mentioned, no one keeps that huge reserve to 15 months of cover. The 8%, 10%.
I want us to do this analysis. You spoke about opportunity cost, and that's why I am bringing in this. The finance minister, when presenting the policy in Parliament, he made mention that if you look at a year like 2022, we accumulated reserves of about $3 billion US, and that came at a cost of $615 million swaps. And in terms of 2023, we did about $2 billion. The cost was around $476 million. 2024, we did about $650 million, and the cost was about $67 million. These were costs associated with swaps and sale of buyback clause. Don't you think that if you combine, if you look at you do a comparative analysis of the opportunity cost of dealing in swaps and going ahead to say that, well, prices are high, we can take advantage of the market, we are the largest producer of gold in Africa. Don't you think that this is possibly better than waiting to actually go on the tangent of dealing in swaps and sales and buyback cross?
So I think he was, I listened carefully to the finance minister. He was trying to make the point that the then economic management team using that model was not helpful. What the model he's also proposing, to me, is okay, but the fact is that the opportunity cost of you using your money to focus on development, but tying it down in reserves of gold. We all know gold price will appreciate, even though it has a high volatility, but it's on an increasing trend.
To you on the points you made, but definitely let me come back to studio and get answers from Dr. Theo Champon. You were jotting down a lot of things.
Yeah, I'm just a bit surprised that some of the remarks my honorable is making in relation to the indicators. Like he says, all the key macro indicators are suffering, and I'm like struggling a bit to reconcile that, because if you watch him very carefully or listen very carefully, all the data points he's spoken about, at least 90%, he's just talking quarter on quarter, right? Picking Q3, comparing to Q3 or even 4 of another period. Why not talk about the whole year? Why just selectively pick quarterly data point to paint a picture that is actually not fully reflective of the true situation? I struggle a bit, because really, if we're talking about key macro indicators, you would first start off with maybe the first three, right? Inflation, interest rate, exchange rate. Why did he not speak about any of them, at least on a year-on-year basis? Compare year-end December 25 numbers to maybe December 24 or even other periods, right? So the point I'm just trying to make is that when we are making these arguments, I feel we have to be fair to Ghanaians, and we have to speak to what the data says, not just cherry pick a few data points, especially quarterly data points, to paint a picture that is completely devoid from the reality. And I think, it even goes to us in the media space. Like I have seen this quite often, where we invite people, they come, and you see the data they are speaking to and the interpretation they're putting to it is completely devoid from the reality. He makes a good point when it comes to what we want to do and what the gold, the reserves policy allows you to do. But again, there's a bit of a misinterpretation there in terms of you're not just building reserves, like I said, for reserve's sake. That is not the case.
It's a means to...
It's a means to an end, right? And I also made a very important point that you have a window of opportunity. Gold prices would not stay high forever. You look at the data, go back, and really what you've seen in the last few years, it's a bit of, statistically, it's even an outlier. It's an abnormality. It doesn't happen that often. And we are the same people that often would say, but the price went high. What did we do with it?
Similar words, what happened in the cocoa space, right?
With cocoa, price went up. We had forward sold the beans at locked in around 4,000. We couldn't even deliver on the volume. So you lost on a double whammy front, both on price and even on volume. And we still have to recover from that. So the fundamental point which, we're trying to make and which Prof also raises is that in all of these discussions, there are trade-offs that have to be made, right? Trade-offs in relation to what your short-term goals are and what your medium to long-term goals are, right? And you have this window that you have to maximize the gains that you're making to help build the reserves. And I give you the evidence of what other economists have done, right? Once they've gone through these sort of crises, and you can look at the data, right? Again, from what I sort of have here, right? You showed it earlier when you were talking about. We had never in the last sort of 25 or 26 years done any more than 4.1 or about 4 months of import cover. It's only in the last year that you're going beyond 5.
Yeah, 5.
Okay. Even when we had those relatively high, call it more than the 3-month IMF benchmark, we still ended up going into crisis because you've had to always then burn your reserves to actually prop up the currency. And then you also then eventually have to go to the IMF for one form of bailout or the other. The other alternative has been that in the process of building up some of these reserves, you go to the Eurobond market to actually go and borrow, isn't it?
Comes with interest.
And in the last few years, we had been doing on average about $3 billion, right, a year. Now, if you even did $1 billion a year, and the typical coupon rate is 7 to 8%, that is $70 to $80 million of interest that you're paying every year just, right, to service that loan facility. You've got an opportunity now with gold where you're able to actually buy some of that gold, of course, at a discounted price. And importantly, now you're actually using local currency, right, to do that. And if you look at the policy statement that it's out there. So again, just public education for our listeners that want to get access. The policy document is available on the Ministry of Finance website. It's quite comprehensive, close to about 24 pages. And there's a cost-benefit analysis that has been done, and also a costing of what it would take to actually attain or meet, right, these targets. And if you look at paragraph 37 of that document, it states very clearly that Ministry of Finance would be making, quote, budgetary allocations to the gold board to meet the objective of the policy. And then it talks also about the paragraph 39, the financing, right, enablers. And it talks about gold board getting arranged funds of about 15 to 20 billion to allow them to meet their continuous operations. And part of that money, when they sell, right, the gold, will come back in dollars to support your reserves. They will use some also for their trading and related, right, activities, so call it working capital, right? And if they manage to then declare a profit or a dividend, that again would come back, right, to the...
So I'm looking at
so this. Just to finish, the key thing, I think, then becomes how do we ensure that, one, this is robust, number two, it is transparent in terms of the accounting, and then you also have all the audit processes and safeguards, and even what Gold Board does itself, the traceability schemes to ensure that you have non-call it galamsey gold, right, entering the supply chain. Those for me are genuine and valid questions that we can have a conversation.
Traceability is very important because that would determine the losses associated with this program. In fact, in terms of the cost-benefit analysis, this was a comparison that was done in the policy documents where if we are to go with a current model where if you are acquiring about 10 billion in Forex, that is going to cost us about, I think, $240 million, right? That's the cost of the program. And if we're getting this at any commercial rate of about 8%,
so
that's
10 billion in gold.
In gold, right?
Yes.
That would have been about 240 million
yes.
as a cost, right, to the state. If you're doing the same on a commercial level, say getting it from Eurobonds or any of the commercial creditors, that would have come with an average coupon rate of about 8 to 7%.
7, 8, yes.
That's about 800 million US dollars. Now, I want to ask Prof, I don't know if you've been able to look at this comparative analysis that has been done in terms of the cost-benefit analysis, because if you're looking at it from the commercial side, looking at our traditional practice of getting these Forex from the Eurobonds and what have you, swap deals, looks like they came at a higher cost compared to this particular comeback. We'll look at the opportunity cost in terms of the social cost and the real cost of this program in terms of what happens if gold prices drop. In fact, we are going to buy gold currently at around $5,000 and keep for the future. What if in the future prices drop as low as $2,000? What will become of the state of the reserves we've built? After this short break, I'll pick the thoughts of Dr. Tue Champon on this very particular question, and then we'll go to Parliament and speak to Mr. Foku also on this very particular issue. Still with us, this is still PM Express. We'll be back shortly. Big questions raised about the opportunity cost of this particular program, especially the social cost. And I was, backstage trying to have a conversation with Dr. Tue Champon. Now, we want to understand, was there any opportunity cost that was done, especially with the social cost? I know you showed me the quantitative analysis for the other side in terms of how this will cost, but in terms of the social cost, what we could have actually used this money for in terms of development, was there any analysis that was done in terms of how this can actually impact the economy?
Yes, so some analysis has and was done. But what is also very interesting is that the decision to pursue this policy is not happening as though you are not doing other interventions. So we're just talking here where I did mention that today the ministry put a statement out, right? And it says that now that the road is almost clear with the post-DDEP, the domestic debt exchange, you can go back to the capital market. You are looking at how you can borrow less from the short end of the market, so less T-bills, and rather now do more medium to long-term, right, instruments. So issue 5-year bonds, issue 10-year bonds. We are the stock and in the budget, the 10 billion, right, bond that the government will be pushing out to help finance roads and other, right, infrastructure projects. So the point I'm really trying to make here is that when you do the social analysis and then you look at the broader context of the other interventions that are being made, right, this is not just like a binary choice. So it's either this or that. You have other things that are being made, and you then do the net analysis to arrive at a position that says, okay, given all the trade-offs that you have to take into account, given the fact that a year or so ago, you would have had some of these goods, right, not passing through the formal financial system, right? You had the people come by, some will be smuggled and all of that, but now you're able to channel that and you're able to use that to support your reserves, your exchange rate, drive down inflation, and all those other things. The net benefit really, for me, sort of far outweighs the relative cost that we're talking about.
Now, I'm thinking about this question in my head, and I'm asking, is this a fiscal policy or a monetary policy?
It's a combination. So think about it, right? So what Gold Board is doing in the past was Bank of Ghana gives you money. It buys gold, supplies the gold to the central bank. The central bank adds it to its reserves and then all of that. Okay. Now Gold Board is going to be trading on its own balance sheet, right? So everything it does would now not sit within the realms of the monetary policy side, but rather right on the fiscal side. So think about it as to be a bit technical, like a quasi-fiscal right operation that straddles both the monetary and the fiscal side of the equation. But the end objective really is that you want to be able to support the reserve accumulation and take advantage of the window of opportunity that you have. And if I may maybe quickly, people have said, it's not possible, and then all of that. If you do the actual technical kind of analysis, right, what would derail this really would be, okay, if you are not able to get the gold volumes that you say, right, you need. And then number two, if the gold price actually, right, falls. And if you look at the policy document that was put out, there's a bunch of tables in there that shows you different pricing ranges and sensitivities that scenarios that we actually have done. And if you look at some of the threshold gold prices, if price were even to drop to say $4,000 right an ounce, right, relative to the amount that you have to add in your baseline scenario, you're still adding around $20 billion to your forex, or under 20% compared to your baseline. So the point is that even if your 15.7 months, right, you don't even meet it for argument's sake, you would still be able to add enough that, imagine if we are even able to double what we're doing now, 5.7, go to 10 or 12 months of import cover, the game changes in the sense that you have enough that is available to support right your economy, and then whilst you're pursuing all the other reforms, all the other things to grow your non-traditional exports, all the other things to increase productivity, all the other things that you're doing in terms of the infrastructure requirement and the bonds and the long-term end of the market, all of these things collectively come together to position you or position the economy to be one that is really, really robust. We need to move from the pro-cyclical ways of having done things over the last 30, 40 years and really sort of chart a new path. And I believe that what gold is offering us in this 2-3 year window of opportunity, we probably wouldn't get it right again, and we have to maximize that.
Now, how involved is the central bank in this whole policy arrangement? Are they really involved?
Of course, the central bank could be involved. The central bank is part of the people that...
Because the reason I'm asking is that the governor, before he became the governor, he had an interview with Raymond Akwa on Upfront, and he seemed to be against the idea of just buying gold and storing as reserve. But now he is the governor, and there's a new policy to accelerate reserve accumulation, and everything is based on gold.
Yes, based on gold, but remember that your reserves policy, so what do you keep in your reserves? You will keep forex, different currency mixes, maybe dollars, maybe euros, maybe pounds, and also you also keep some gold, right, as part of the reserve. So reserve management is actually dynamic. What is very important here is that in the process of adding onto the gold onto the reserves, right, just like the bank did a few months ago, where they were able to convert a part of the gold that they have into liquid currency because of the price movement, you are in a position to actually do the same. What is important is that you have the volume in terms of the gold, and then at any point, if you sense that the markets are going to move one way or the other, you can sell, or you can even take a corresponding put option, right? That minimizes your downside scenario. So it's really part of the active or dynamic reserve management policy.
My biggest concern now is also on the issue of traceability, because I look at the scheme, you are buying from the big scale or the large scale at discounted price. A small scale sector is going to be on a spot price, right?
Yes.
And this is where we have the challenge of Galamsey gold, where a lot of the gold coming from the small scale, you cannot trace it. And I understand that our program of traceability is still being piloted. How do we build a program that is about 80% dependent on small scale gold that is difficult to track? You want to sell and get premium price. If you cannot trace it, you cannot get premium buyers. How is the program also going to deal with that?
Yeah, no, so good question. And there's a lot of work that Gold Board and its partners are doing when it comes to that part. Before I answer that, let me quickly address the large-scale mining side and then the issue of the discount. Again, you look at the policy under the old domestic gold purchase program, you're actually buying gold at the refined end, so like 99.9% or so purity. What we're saying this time around is that you will buy the unrefined gold or the door gold that would normally have about 90% right purity, and then you get it from the large-scale miners at a little bit of a discount. And then because you now have a domestic refinery, right, you can actually refine that, add a little bit of value to it, and depending on the trading strategies that you have, you can make a bit of a delta of value, right, within that process. So that's basically how that works. For the small-scale side, that has been, of course, the biggest challenge. And then that everybody recognizes Galamsey is a big issue. And we have attempted to solve it in different shapes and forms, sometimes unsuccessfully, right? So the work that Gold Board is doing, and a lot of the effort is really going around that traceability value chain system. There's things like blockchain that is being talked about. They are setting up a portal or a system that you can actually, based on the isotopes, right, of the gold, you can actually trace back down to even the source of where, right, that gold was being mined. So this is a lot of work that is being done. The technical details, I am sure Gold Board would be putting some of that out in the near future or in the next coming weeks. But what is really, really, really key is that we ensure that the gold that is entering that value chain and that you're selling to other buyers to get, dollars, one, is clean gold. It's not tainted gold. And you're able to account and show the paperwork that says that this was gotten from X mine in somewhere in the Western North region or somewhere in the Eastern region. And you can trace the provenance of that gold all the way to the end buyer.
What happens to a gold door that cannot be traced?
If it's a gold door that cannot be traced, that's problematic, right? And that is an issue. But I know that what Gold Board is doing now is that every gram or ounce of gold that is entering the value chain is being bought from reputable. Right?
So what will Gold Board do with gold that they cannot trace?
Currently,
aggregators bring and they cannot trace.
No, so currently what they're buying is coming from reputable buyers. They have their ESG systems in place. They are doing the compliance checks and then all of those, related things that they need to do to ensure that you're actually buying credible gold.
And the law requires that domestic gold trade is supposed to be done by Gold Board, the purchase of gold and the trading of it.
Yes.
So if gold is buying only reputable gold, who then is buying the Galamsey gold?
But before even the Galamsey gold, some of them was being exported. So it's not as though because you have Gold Board, suddenly all the illegal bits that was being exported are suddenly vanished. I mean, we'll be lying ourselves here, right? So there is still some gold that possibly, right, is being channeled through other means that perhaps maybe it's not coming through the formal.
So what Gold Board is buying,
so what it means is
the
that
program will not be Galamsey gold.
Yes. So, but what it means is that Gold Board needs to even ramp up more its compliance effort, right? So beyond offering the carrot, which was that you will give you a bit of a premium to encourage people to bring their hitherto gold that was going through other to Gold Board. Now that you have a bit of control of the market, you can start actually cracking the whip and make sure that things are coming to.
I see in this program, I can do a simple, time series analysis and say that in the long run, Gold Board is going to make losses. When they make the losses, how are we going to actually solve this in terms of the losses that will be made by gold board, is it going to be taken by government of Ghana? Because I read, I mean, the minister, when presented to Parliament, he says that the associated loss, the two parties where he meant the gold board and maybe the Bank of Ghana, will see how they will strike the balance.
So that is for 2025.
Okay.
Right? But there's nothing that indicates that in 2026 or 27 or 28 we'll be running at a loss. So I would like to speak on the loss that you've got currently, or the trading, right, related loss. So basic question is that where does that sit? You look at the IMF fit review report. It's also picked up, right, and that it has to be a shared cost because ultimately the fiscal authorities also benefited, right, from it. So that is a conversation that is ongoing, and the value will have to sit somewhere in terms of the books, either at the central bank or with the Ministry of Finance.
Finally, from Professor Prepra, 2 seconds. Do you also see losses in the long run?
The way it's structured, the first one, the caution is that I am not expecting government to go and borrow to go into this program. So if government does that already, they have one leg of cost to cover. Gold itself, which is a very volatile commodity, we all know for us in finance, volatility comes with higher risk, higher return. We are not setting up the future, so that future cost is also unknown. There is also the social cost computation, which must be really done. We've done well with the quantitative side, cost-benefit analysis pointing to positive in terms of the reserve side, but what will happen to gold board is unknown.
Okay.
So these are the issues that must be looked at. The ultimate aim, if listening carefully to Dr. Teo, I see that the government is focusing on how do we ensure stability of prices. And in economics and finance, when we say pricing, your ultimate aim is your exchange rate.
Okay.
So this policy is towards ensuring price stability in the line of exchange rate. And we all admit that in Ghana, 90% of our whether what causes cost to move up is related to exchange rate. So if government is able to do that,
all right,
whatever be the cost, if you mitigate it against that one, the end effect will be positive.
Unfortunately, this where time will allow us peg our conversation, and I really was dying to hear from Mr. Fokio. But I mean, some 10 seconds bite. What do you also see in the long run? 10 seconds, please. Hello, Mr. Fokio. Well, this is where time will allow us to peg our conversation. This has been PM Express with me, Isaac Kofi. And gentlemen, I'm so grateful that you could make time to join us, and do enjoy the rest of your evening. Thank you very much.